Hey guys, am I audible? Please enter Y if I'm audible in the comment chat box. Okay, great. A few more Ys, please. Yeah, great. Okay, let's start the webinar. I have presented a slide and I wanted to share it with you guys. And first of all, I would like to say that it's my first webinar, so please don't mind if I make few errors or mistakes. Okay, Sudhira is not able to hear me. Give me a second. No, I cannot see you guys. I just can read the chat box. Whenever you have any doubts, you can write in the chat box. I'll answer the questions. Sudhira, can you try? Can you check your audio once again because everyone else is able to hear me? Okay, I'll start right now. Are you guys ready? If you are ready, please enter Y in the chat box. Few Ys, guys. Okay, great. So I'll start the webinar. Just give me a few seconds. So let's start with my introduction first. My name is Kritesh Abhishek and I'm an electrical engineer from NIT Warangal. And you might know about NIT if you have done engineering, but it's not very famous in India. I started TradeBrains last year in January, and at that time I was working as a manager in Tata Motors. However, I got bored with the job very fast within 18 months, and then I left. I have over 3 years experience in investing. I started investing in my college days only. And recently, I also got NSE certified for fundamental analyst. It's a simple certification course that you can do on NSE website. And the questions are quite straightforward and generally from the booklet only. So if you want to get certification, you can do that from NSE website. Now, without wasting any time, let's start what is value investing and why you should invest. First, why you should start investing. For financial independence. So let's say after 50 years, after at the age of 60 to 70, if you want a financial independence and you do not want to depend on paychecks to paychecks or your kids, then investing is a very good source to create a financial independence. Moreover, children are not your retirement fund, so you should start working on yourself so that you do not have to depend on anyone after retirement. Second, it creates a secondary source of income. For example, if you invest rupees 10 lakh and it gives a return of 10% in a year, so you will receive a 1 lakh rupees in 1 year. So it can be treated as an additional month income. So here, what I want to say that you worked only for 12 months and you get paid for the 13th month. For the last month, your money is working for you. So it's a source of secondary source of income. And third is like planting a money tree. Maybe you won't receive much money in the start, but however, as the plant grows big and older, you will generate a good revenue and it will give you good returns. Moreover, it is said that investing is not a want, it's a need. There's a famous quote by Warren Buffett. It says that something is someone sitting in the shade today because someone planted a tree a long time ago. So start investing a little today and allow yourself to live like a king tomorrow. Now, even you do not need a large amount to start investing. For example, if you invest rupees 1500 per month and you get a return of 15% annual, now this is achievable using value investing strategies. I'm not asking about 25%, 35%, or 50%. 15% is okay, you can achieve using value investing. So if you keep invested for 30 years with an annual return of 15%, you will generate 1.1 crore by 30 years. Now again, you can argue that Kritesh, 30 years is too long. But if you look at the present scenario, it's not too far. Like most of the people generally live at the age of 70, 75, even 85. My Nanaji, that is my maternal grandfather, he is 87 years of age. So even if you retire at 60, you have 27 more years. So 30 years is not that long. Even if you are in 30s or 40s and you start investing now, so you will get this much amount in your 60s and 70s, and it will help you a lot. And this is a very good amount to sustain after your retirement. You will get a very good return and you can live 15, 20 years without depending on anyone. Moreover, if you see here, if you invest only 1500 rupees per month for next 30 years, your invested amount will be only rupees 5.4 lakhs. However, the wealth created will be 99.7 lakhs. So this is the power of investing. Here, two factors are playing a crucial role. First is the return rate, how much return you are getting, and how much is the duration of investing. If both of them are increased, your wealth creation will increase a lot. That's why it's better to start investing as early as possible. I've collected a data about how your wealth will grow over the years. Here you can see that in 10 years you will get 4.2 lakhs. By the end of 20 years you will get 22.7 lakhs. By the end of 30 years it will turn out to be 1.1 crore. And if you wait for 5 more years, just 5 more years, it will double itself and it will turn out to be 2.2 crores. That's why it is said that a year from now you wish you had started investing today. So why investing in stocks only? Historically speaking, stocks have outperformed all investment options like FD, silver, gold, etc. Now, I do not want to discuss unconventional methods like cryptocurrencies or futures and options here. But if you compare this with the traditional options, then historically speaking, stocks has outperformed all the other investment options. And they are the best alternative to fight inflation. You can understand it better with the help of this figure. So assume that you invested rupees 1 lakh 37 years ago, that is in 1971. So as of today, this 1 lakh, if you haven't invested anything and just have kept as cash, it would have turned out to be rupees 8,000 or 9,000 because of inflation. So inflation was 6 to 10% average in these years, and all those years the value of money would have depreciated. So it have turned out to be rupees only around 10,000 by now. But if you have invested in FD, it would have turned out to be around rupees 19.75 lakhs. If you have invested in silver, your investment would have turned out to be rupees 24.46 lakh. If you have invested in gold, it would have turned out to be rupees 36.53 lakhs. However, for Sensex, that is the index of market, if you have invested in Sensex, it would have turned out to be 2.53 crores. Now you can see the margin here from FD gold, silver versus Sensex. Moreover, unlike other assets, Sensex has dividend yield also in addition to capital growth. Please enter a Y if you know what is a dividend. Guys, please enter Y in the chat so that I can know that you understand what is a dividend. Okay, great. So if you okay, great. So if you add this dividend in the capital appreciation, it will turn out to be 2% extra than what you received, and overall your wealth would have turned out to be rupees 4.76 crores. So here I'm not even mentioning the dividend part. I'm just saying the wealth creation by capital appreciation would have turned out to be 253 times. In short, you can see that FD would have given you a return of 20 times, gold 37 times, silver 24 times, Sensex 253 times. Akshay, sorry, I just saw your message. I'll send you a detail about dividend to Akshay in a mail. Right now, I need to continue, but I'll send you detailed information about what is dividend in a separate mail. So to put it in another word, in the last 70 years, Sensex has given a return of 253 times. Now, I'm not made these numbers, and if you want to get where I collected this source, I'll share you the link which you can study further to understand how much returns Sensex and other investment option has given. I've already mentioned the source in the bottom of this slide. So this is the chart of Sensex over the last 30 years. So you can see that the Sensex is growing over the past many years, and India is a growth country. It is predicted by IMF, that is International Monetary Fund, and World Bank, that is India will be growing at the highest rate in the next few years in all over the world. So it's the best chance for us to invest in the growing economy of the country. So how to correctly look at stocks? So if you have read the headline that I have used in this webinar, it said that when buying shares, ask yourself, would you buy the whole company? So that's the basis of a values investing. In stocks are the part of the business, and you want to invest in stocks. For example, if suppose I say there's a company which is giving good returns of 30%, and it makes methyl chlorine or profile ethanol, anything. So if you do not know what is the company, do not invest in that stock, because you cannot predict whether the people are going to use that product or services in next 15 to 20 years. First, you need to convince yourself that what is the business, and you should be ready to invest in the business. And look at the business, not the price. An increasing price is not the reason to buy a stock. And similarly, a decreasing share price is not a reason to sell the stock. This is the basic of the fundamental analysis. So there's a famous quote by Peter Lynch, who is the author of the book One Up on the Wall Street. And he says that the basic story remains simple and never ending. Stocks aren't lottery tickets. There's a company attached to every share. And you need to find that company and invest in that company, not in the share price, not in the stock. So value investing principles are very simple. First, you need to find high quality of companies, and you need to purchase them at a bargain price. That's the funda we are going to discuss in this video and this seminar. Finding great companies which are capable of giving amazing returns to their investors and purchasing them at a bargain price. Now, for finding the bargain price, you can use various methods, like you can find the true value using DCF, discounted cash flow, dividend discount model, ROE valuation, PE valuation, dividend yield valuation. There are different methods for that, and you can also use relative valuation. I've covered a lot in my course, but I just wanted to give you a brief introduction about how you can value the stocks. But right now, for the introduction part, you need to understand that for the value investing, you need to find high quality of companies and you need to buy them at a bargain price. So let's quickly summarize what you have studied till now. First, stocks are the part of businesses. Invest in business, not stocks. Finding good business and purchasing them at a bargain price is the key to successful investing. Now to the next section, how people actually make this money from the stocks. Now I'm going to discuss very few things in this section which might be a little new, but it will be very interesting. So the first method is very simple, capital appreciation. That is, you buy low and sell high. Everyone knows this method how to make money in stock market. They need to buy at a very small price and wait till the price go up, and they will sell the price when it is high. And the difference between the purchase and the selling price will be your capital appreciation and the profit that you will make. Few of the best example of capital appreciation is like Eicher Motors. Bullet bikes, that is Royal Enfield, comes under the brand of Eicher Motors. So it has given a return of over 120 times in the last 10 years. And even if you can see that there is not much effect of the great recession of 2008 in this stock. So it's a very good stock and it has given a great return to its shareholders. If you have invested 1 lakh in Eicher Motors in 2008, it would have turned out to be 1.24 crores. Next is MRF. Again, this has given 23 times return in the last 10 years. 1 lakh invested in 2008 would have turned out to be 23 lakhs. And the next is Page Industries. This is the brand of Jockey. You might have used its underwears and innerwears. It has given 51 times returns in the last 10 years. So 1 lakh invested in 2018 Page Industries would have turned out to be 51 lakh. So these are the examples of capital appreciation. The next one is dividends. So as you already know that dividends are the profit that company shares with its shareholders as decided by the board of directors. Now please be careful, please pay a little more attention to dividends because most of the investors ignore the dividend parts, and it's really important to understand the power of dividends. So the first thing that you need to understand here is dividend yield. Dividend yield is equal to dividend per share by price per share. So let's say if a company gives a dividend of rupees 10 and has a current market price of rupees 200, so its dividend yield will be turned out to be rupees 10 by 200, that is 5%. So most of the dividend investors who invest in the dividend stocks, they look at this factor, that is dividend yield, how much yield they will be getting per year. So similarly to bank account or FDs, like they give 8.5% or 3.5%, you can notice that this is the yield that you will get annually if you buy that stock. So here are the few examples of famous companies which have given dividends last year. SDFC has given a dividend of 11 rupees per share. Coal India has given a dividend of 19.90 per share. Now this is for the last year data, that is 2017. Hindustan Unilever has given a dividend of 17 rupees per share. Reliance Industry has given a dividend of 11 rupees per share. ONGC has given a dividend of 6 rupees per share. Now, but you might here consider that, wait, it's too small. That is, if you want to get a dividend of rupees 19,000 from Coal India, you have to buy 1,000 shares. And currently the share price of 1 share of Coal India is rupees 279. So if you buy 1,000 shares of Coal India, it will turn out to be rupees 2.7 lakh rupees. So you might be considering that getting rupees 20,000 for an investment of 2.79 lakhs doesn't make much sense, right? But there's a very important point that you need to understand here. This is that dividends increases over time. So the purchase price, that is the price at which you bought the stock, will remain the same. However, the dividends, if it's a good company and growing, and as it becomes more and as its profit increases more and more, it will give good dividends in future. So dividends increases over time. However, your buying price will remain the same. So if you see the dividend yield, here the denominator will remain the constant, but in numerator will increase. So your dividend yield is going to increase. Let me explain it further with the help of this slide. So suppose you bought stock at rupees 200 and the dividend yield at that time was 5%. That is, it gives a dividend of rupees 10. So you might consider that it's not a big amount. So why should I only invest for the dividends only? However, if the company is going at a very good rate and it's giving a consistent increasing dividends for the years, you can notice that if in the next year the company increases its dividend by 2 rupees and it started giving a dividend of rupees 12 per share, here your purchase price is same, that is rupees 200. So your dividend yield will turn out to be 6%. And in the next year, you will receive a dividend of 12 into 100 shares, that is 1200. In the third year, let's imagine that the company again increases its share dividend by 3 rupees. So for the third year, the dividend turned out to be rupees 15. Again, your purchase price is constant. Maybe another people who buy the stocks, he will buy at a higher price. Let's say the price appreciated to rupees 300. So for him, the dividend yield will be low. However, for you, you have purchased the stock at a discount price, your dividend will be high. Here it will be rupees 15 by 200, that is 7.5%. And for the third year, you will receive a dividend of 1500. If you multiply 15 by 100 shares, that is 1500 rupees. Next year, let's say the company increases its dividend to 18 rupees. So here you can see how the dividend yield is increasing. Now it's even greater than fixed deposit. So for the fourth year, if you divide 18 by 200, the dividend yield turn out to be 9%. And the total dividends collected for that year is 1800 rupees. And let's say for the fifth year also the company increases its dividends to rupees 21. So here again the purchase price is constant, that is 200, and if you divide 21 by 200, your dividend yield is 10.5%, and you will receive a total dividend of 2100 in that year. If you add all the dividends in the 5 year, you will get a return of 7600 dividends from dividends only. And the price of that stock also might have appreciated. It might have moved from 200 to 300, 400, or whatever price after 5 years. So dividends increase with time, and that is the important point that you need to understand. Please enter Y if you understand what the concept of dividends, how it increases over time. Great. So that's the power of dividend, and it's very important that you do not ignore dividends while investing in stocks, especially if you're a value investor. So I want to understand it further with the help of an example, that is Hindustan Petroleum. So first of all, this is not a recommendation. I'm just using this example to explain the concept of how people make money. So let's say if you bought the stock 5 years earlier, and if you adjust all the bonus that the company has given, it has given bonus for the last 2 years. So its price would have turned out to be rupees 69.3 5 years before. So if you have bought 100 stocks of HPCL 5 years ago, so your investment amount, that is adjusted investment amount, would have turned out to be rupees 6,930, right? And right now the price of HPCL is rupees 315.50. So it has given a capital appreciation of 360%. It's again a very huge amount. So your investment of 6930 would have turned out to be rupees 31,363. This is just the capital appreciation. Now again, you do not need to ignore the dividends. So let's move forward to understand the dividend parts. So this is the data of dividends. I've collected it from the Money Control website. You can also go to Money Control and click on financials, and there's a corporate announcement section, and there you can get the details about the dividends. So here you can see how HPCL has given a good dividends over the past few years. If you see 2013, it has given a dividend of 8.50 per share. So if you had a total of 100 shares, you would have got a total dividend of rupees 850. In the next year, let's say it has given a dividend of rupees 15.50. So if you have 100 shares, it would have turned out to be rupees 15.50. In 2015, it has given a dividend of rupees 24.50. And For the same total number of shares, you have received rupees 2450 from the dividends. However, in the fourth year, it has given a bonus of 2:1 ratio. Guys, if you know what is bonus, please enter Y, else I'll explain what is a bonus. Okay, so a bonus is like an additional share which is given as a reward to the shareholder. So let's say if you have 100 shares and so let's say if you have 100 shares and company announced a bonus of 2:1 ratio, this means that for every one share you will receive two additional shares. So the company announced a bonus of 2:1 in 2016. So if you have 100 shares, it would have turned out to be okay. Bhavesh has already given a brief description about the bonus here. However, I'll also add few points. So if a company gives a bonus of 2:1, it means that if you have one stock, you will get two additional stock from the company. So here you have 100 stocks, and for 100 stocks, you will get 200 additional stocks. So totally, it will turn out to be 300 stocks. So by the end of the third year, you will have a total of 300 stocks. And if you multiply 300 by the dividend of the third year, that is 34.50, you would have received a total of dividend of 10,000 plus 10,000 rupees in the third year. In the fourth year, sorry. In the fifth year, again, this company has given a bonus of 1:2, which means that for every 2 shares, you will receive a bonus of 1 share. So your 300 shares would have So your 300 shares would have turned out to be 450 shares. Yeah, the price will become, yeah, one more thing. Sujit has asked that the price will become half. Yeah, that's right. That's why in the starting, I have already said that it's an adjusted price. That is, the price is going to adjust. So additional dividends you are going to get because you are holding more number of stocks now, but the price will get adjusted. So in the fifth year, you will have a total number of 450 stocks, and it has given a dividend of rupees 30. So if you multiply number of dividends by total number of shares, it would have turned out to be 13,500. So overall, you would have got 28,700 rupees just by dividends in the last 5 years. So this is example of how dividend works. You can see how dividends and bonus both adds up to your total wealth creation, and it helps you to create more and more wealth over time. So in short, if we summarize, you can see that your total invested amount was rupees 6930. Your dividends received was rupees 28,700. Appreciated value was 31,360, and the wealth created will be sum of both dividends and appreciated value. Moreover, even if you haven't sold the stocks, you already have got 4 times returns from the dividends only. Plus, your capital has also appreciated. So here you can see the dividends are also very good way to generate wealth. And if you want to get a good returns, consistent returns in your bank account, so you can also invest in the dividend stocks. So few points of concerns regarding dividends. First, dividends are not obligations. For example, fixed deposits and savings, the bank has to give you that interest. However, dividends are not obligation. This means that it's not guaranteed that the company will give you dividends over the year. For example, if the next year the company doesn't make much profit and their profit starts declining, or if they have any other plan, like they want to start a new business or open a new plant, anything, then they might not give you dividends. So if you're investing in a dividend stock, first you want to make sure that the company has a good record of dividends. So let's say a company is giving dividends for the last 20 years consistently, and the dividends are increasing over the time. So it's a very good So here you can see the pattern, and you can expect an increasing consistent dividend in the upcoming years. So these are the points you need to these are the points of concern that you need to take care while investing in the dividend stocks. So let's summarize what we studied till now. First of all, people make their money from stock market using two methods. The first one was capital appreciation, where we saw how Eicher Motors, Page Industries, and FIMRF appreciated a lot in the value. And the second is dividends, how even dividends can give you a very good returns, and how dividends increases over time. And moreover, the important point for a value investor is that dividends should not be ignored while studying stocks. So let's start the third portion of this. Okay, there's a question that is, which category of stocks will give more dividends, large caps or mid caps? The point is that the growing companies that are like mid caps, they need to reinvest their profit in their company. Like if they want to expand in new countries or new cities, they want to buy new assets, or they want to open new plants or any accessories. So they want to reinvest their profit. Therefore, for the growing companies and mid caps, they do not give you much dividends. However, for a large stable companies which do not have much growth opportunity, they want to give back to their shareholders. So the large companies generally give good dividends to the shareholders. But again, here you need to confirm that how much dividends, what's the track record of the company, how much dividend it has given over the past years. So if it has given a consistent dividends over the past year, and moreover the dividends are increasing, then it can be said a good sign. Yes, Anand. 2:1 means for 100 share you will get 50 more shares. However, for in that case, you had 300 shares. So for 300 shares, you will get 150 more shares. Therefore, it would have turned out to be 450 shares. Do you have any more questions, or shall we start the next section? Please enter a Y in the chat box if you want, so that we can start the next section. Guys, I really need your participation here, because I cannot understand if you are grasping or not. Please enter Y if you want me to proceed further. Great. So let's start the next section, that is financial statements. So to be honest, you might not find this section very interesting. However, this is a very important lecture. Knowing how to read financial statements differentiate a good investor from a mediocre one. And as I promised, I'll try to keep the things very simple. First of all, every public companies by law have to report their financial statements to the shareholders and the regulators. SEBI, that is the Securities and Exchange Board of India, is a regulator, and they looks for any cheating or fraud by the company against the shareholders' interest. So you might have heard that SEBI has delisted few number of stocks from the stock market. In short, SEBI is like a financial police. So they take care of whether the companies are cheating their shareholders, or they are manipulating any financial statements and all. So that's the role of SEBI. It was incorporated in 1992, and after that, it has made a lot of rules and amendments to take care of the shareholders' interest. Now, where you can get these financial statements? First of all, you can go to the BSE and NSE website. All the companies report their quarterly and annual reports on the BSE and NSE website, and you can get the data from there. Second is the company's website. So it is the best source, because here you can go in the investor section and you can download all the important news like corporate announcements and annual reports, or any other report that the company wants to share it with the shareholders. And the third is financial websites. It's like Screener, Money Control, Investing. So you can go to all these websites also to get the financial data of the company. Now, if you're a beginner, you might want to visit Screener because on Screener, all the data is customized. It means that they have reduced all the clutters and only focused on the important points of the financials website, on the financial statements. So if you're a beginner, Screener is a good website to get started. So there are three important financial statements that you need to understand. The first is balance sheet, second is income statement, and third is cash flow statement. I'll discuss all of them one by one now. The first one is balance sheet. Guys, just give me 1 minute. Okay. So balance sheet is a financial statement that compares the assets and liabilities of a company to find the shareholders' equity at a specific time. Now it's not really complicated. Suppose let's take example of a person only. So let's say for your case only, if you have a house, if you have a car, and you have some cash in the account, so these can be considered your assets. And let's say you have some liabilities like education loan or car loan, so these can be considered as your liabilities. And when you deduct the liabilities from your assets, then it will give you your net worth. So let's say you find out what's the worth of your house, car, and cash in the bank account, and you reduce your all the debts and loans that you have taken, then it will tell you what's your total worth. In the same case, balance sheet also shows what's the total assets and liabilities of a company. So the balance sheet adheres the following formula, that is assets is equal to liabilities per shareholders equity. So shareholders equity is just a fancy name for net worth. So it's not much different from net worth. Financialists use this word only to in the place of net worth. So, but you can use net worth also. So here you can see if you reduce assets from liabilities, you will get shareholders equity, that is the net worth. So why a balance sheet important? It helps an investor to judge how a company is managing its financials. So here you can see assets, liabilities, and equities of the company, and it gives you a basic idea what the company owns and what it owes, like what are its assets, like what are its machineries and plants and lands, or these are assets, how much the assets the company is owning. Similarly, it also gives you an idea about what's the liabilities that the company has. So it's a good way to judge the financial position of a company. I'll explain all these details with the help of a live example, that is a balance sheet of a company, after the end of this section. But for now, let's understand just the basics. What are the basics elements of the balance sheet? So for the asset side, asset is an economic value that a company controls with an expectation that it will provide future benefits. So it can be cash, land, property, inventories, etc. And assets are broadly divided into three parts. First is short-term assets. These are like those assets which can be liquidated easily, that is within 1 year. For example, cash in hand, inventories, or account receivables. So account receivables, for example, the company has sold some product to its customers and they have not paid right now. So that are called account receivables, and these amount the company has to get back. So that's a short-term asset. Then there are the other type is fixed asset. The fixed assets are land, properties, equipments, etc. And the third part is other assets like financial investments, intangible assets like patents, copyrights, trademarks, etc. And when you sum all these three types of asset, it will give you the total asset of the company. Don't worry if you find it a little boring right now, because I will explain it to you with the help of example from a balance sheet of ITC or Godrej Consumers. I have two balance sheet right now, so don't worry if you do not understand anything right now. For the liabilities part, it is the obligation that the company has to pay in future due to its past actions like borrowing money in terms of loans for business expansion purpose, etc. Again, like assets, it can be divided into three parts: short term liabilities. These are like payroll, account payable, taxes, etc. Account payable, it can be considered like, let's say a company buys some raw material from a company, from its supplier, and they have to pay back for that raw material. So these are called account payables. And similarly, there are taxes that needs to be paid. And for the non-current, that is the long-term liabilities, these are borrowings or long-term borrowings or the trade payables, etc. And there are other few other liabilities also, like deferred income tax, etc. So we will see all this with the help of example of ITC, where you can understand it better. The next is income statement. So an income statement is simply a profit and loss statement, and it tells you how much profit a company made in an year. So overall, an income statement summarizes the revenues, cost, and expenses incurred during a specific period of a time, usually a fiscal quarter or year. The basic equation here is revenues minus expenses equal to profit. So let's say a company may have sold the products worth rupees 100 crores. However, it has expenses like raw materials and publicity, marketing, sales department, payrolls, etc. So all these come into expenses. So when you deduct these expenses from the revenues, then it comes profit. However, even that profit is not the exact profit that the company will get, because they also have to pay taxes to the government. So we will look into an income statement to understand how the income statement actually looks like. In simple words, you can understand that what the company takes in is called revenue, and what a company takes out is called expenses. So you give a payroll, you pay for the raw materials, or you pay taxes. The different Anand asked, revenue means turnover. Yeah, in one sense, in simple, you can consider revenue as turnover. And the difference in the revenues and expenses is the net profit or loss. Now, most of the investors look income statement of a company to understand what's its financial worth, and moreover, they look at the growth of the earnings. So you might have heard the people talking about EPS, that is earning per share. They might be saying that EPS is growing for the last few years, or EPS is not growing. So they look at earnings per share. How much is the earnings? So earnings per share is found by dividing the total earning by total number of shares. So this is the most important point. This is one of the most important point that many investors look at, because you want to invest only in those companies which are making profit. A company a company cannot grow if the underlying business is not making money. So let's say even if it's selling a lot of products, but it's not making profit, so how it's going to give dividends to its shareholders? So these are few points of concern. That's why you need to look at how much the profit the company is making. Now the third one is cash flow statement. It's also very simple statement, and it shows the flows of cash and cash equivalents during a period of under report. It helps in assessing liquidity and solvency of a company and check efficiency in the cash management. So there are three important key components in a cash flow statement. The first one is cash from the operating activities. So these are the cash flow from the running of the basic businesses of the company. For example, the sale or purchase of the goods of the service or services. So these are the inflows from the basic business of the company. So all the cash that is collected from the sales or purchases of the goods, that will be written in the cash from operating activities. The second is cash from investing activities. It is like where the company is investing, how much returns it's getting from the investment. Sale and purchase of new fixed assets, machinery, equipments, improvements, long-term investments. So all these are cash from investing activities. So let's say the company is buying new assets, or they are buying new machinery, or any equipment, or they are investing in somewhere for long term. So these all cash flows will be written under investing activities. And the third is cash from financial activities. So this is the change in capital and borrowings of the business, and here the company raised. So it's again shows the cash inflows and outflows. For example, if the company gives a dividend, so it is the outflow, that is the company is giving the dividend from itself to the shareholders. So it will be mentioned in the cash from the financial statement. Similarly, the buybacks, these are the cash outflows. And let's say that if a company is getting loan or offering new shares, then it's raising money. Here the cash is getting inflow. So these all will be written as cash from financial activities. So these are the three key components of the cash flow statements, and all the three activities you can see and understand how what's the cash flow from all the different activities. For example, if you want to know like where the company is investing and what new assets it's buying, you can look at the cash from the investing activities. Similarly, if you want to see how much dividends the company is giving over the past year, or is the company increasing the dividends over the year, you can look at by using the dividends from the cash from financial statement, cash from financial activities. And most important part is you want to look to cost from operating activities. Here you want the cash from operating activities to be positive. Why? Because you want to make profit. The sales and purchases that you are doing, that is the basic business of the company, that should be profitable. So the investing activities can be negative if the company is investing more. The financial activities can be a little negative. It is if it's getting borrowing loans or issuing new shares or giving more dividends. However, for the operating activities, you need to make sure that it's positive. It's a very good sign that the company is healthy. In simple words, there can be cash outflow and cash inflow from all the three activities, that is operation, investing, and finance. From operation, the company can sell more and buy more, purchase more goods, so there can be cash inflows, outflows. For investing, again the company can invest more, or they can get returns from their investments, so there is cash inflow. And from the finance, again you can see that the company might borrow loans, take loans, or offers new shares, so there is cash inflow, and they can give more dividends and buybacks. These are cash outflows. And the sum of all these cash flows from all these activities will tell you how much the company's total cash inflows and outflows in a specific period of time. For a healthy company, cash inflows should be positive and high. So as I already said that it might be sound a little boring to you. However, we are now going to look at the financial statement of a company, and it will help you to understand it better and easier. So I have the financial statement of ITC company, and if you scroll down, here you can see cash flow statement, balance sheet, and statement of profit and loss. So every company reports this at their financial statements in their annual reports, and you can get the data from there. So if you want to look in the balance sheets, you can just need to go to page number 124, or just click here. So just give me a second, I'll make. So here you can see the balance sheet of the company. As I already discussed, there are three parts of the company, three main types: non-current assets, current assets, and there are other assets also. The other assets here are written in current assets, but these are the basically three parts. So in the current assets, you can see inventories, trade receivables, cash and cash equivalents, other bank balances, loans. So these are the current assets of the company. And here you can again see that the company, it has given the data for the last 3 years, 2015, 16, 17. So all the financial statements that you find generally gives at least 2 years, because you need to compare the performance from last year to this year, whether the assets are increasing or decreasing over time. Now, if you look at the total assets here, you can see in 2015 the asset was 44,754 crore. Next year it's 50,000, and currently it's 54,214 crores. So it's a good sign that the assets are increasing over the year. These are the things that you need to learn, like need to study in the balance sheet, like what are their current assets and their assets and liabilities. Again, if you scroll down here, you can see the liabilities of the company. As we already discussed, there are current liabilities and there are non-current liabilities, that is fixed liabilities. So here you can see that the current liabilities are trade payables, borrowings, financial liabilities, current tax liabilities, and there are non-current liabilities also. So when you add all these current and non-current liabilities, this will give you the total liability of the company. And here is the equity. Equity, again, you can see when you decrease the liabilities from the assets, it will turn out to be equity. And from the basic equation of a balance sheet, assets should be equal to equity plus liabilities. So here you can see that total assets, that is 54,214, is equal to the total liabilities, that is 54,215, liabilities plus equity. Now, an important point here that you should note that that total assets should be greater than total liabilities. Moreover, the assets should be increasing over time and the liabilities should be controlled or should be limited. So here you can see that the liabilities are increasing, which is a good sign. However, here you can see assets are increasing, which is a good sign. Guys, please enter a Y if you can understand what